Hi, I'm Ken from Avvora Finance.
I'm John Gilmovich from Real Property Manager.
Hi, and I'm Debra Beck-Mewing from the Property Frontline, and you're with Property Mythbusters. We're here to bust the myths around the property investing space, and today we're talking about the myth that it's better to buy more rather than renovate. So I'll be kicking off the discussion today. So just a little bit of a market update. So we are still seeing quite intense buying activity around the country, mainly for existing property, property that has potential and that you can renovate. But it has dropped off a little bit. We're still seeing very strong prices, mainly due to stock being low, but of course we'll see that change a little bit over the coming weeks as people start to put their properties on the market. So I'm just going to share my screen. Just hold on one second. Now, where am I? Just going to share my screen. So you can see here, this is the realestate.com demand index. So you can see nationally there has been a bit of a, or it looks like a bit of a drop off in demand. So this is a graph that maps the activities that people do when they're preparing to buy. But look at this, so New South Wales, so here's the national view. New South Wales is right up there. We had a little bit of a dip at the start of August, but like still coming back strong. But the drag, of course, on the market is Victoria. So I'm speaking to a lot of buyers who are saying, oh, you know, there's some bargains coming up, is there? There isn't. So you still need to be on your game when it comes to buying. Now I just need to, I might need to do a bit of editing here because I have to just get my screen sorted so I can show you the results. So in relation to renovation though, or the myth. So it's better to buy more.
So what myth are we busting today, Deborah? I don't think we've mentioned it yet.
I have, John, at the start, I mentioned that the myth was that it's better to buy more rather than renovate. So this is addressing the myth that a lot of new property sellers actually use, where they'll say to people, oh, you can buy 10 properties and then sell 5 and keep 5, and that's how you retire. But this is all just designed to put money in their pockets, not yours. If you buy right, you might only have to buy 1 or 2 properties, and if it's a property that's got potential in it, then you know you might be able to pretty much replace your income in one project. And my example here is a project that a client of mine has just finished. So we purchased this property in a prestige suburb, and we bought it as a renovation opportunity. So it was a 2-bedroom, had rear lane access, and the plan was to put another floor on top and turn it into a 4-bedroom, 2-bathroom. And the project has just been completed, and this is how it looks now. The build time took around about 6 months. The rest of it was preparation, but the uplift will be a profit of around about, of more than 750,000. So you need skills to be able to do this, but there's opportunities like this right around the country in practically every established suburb in Australia. But to do it, you actually need to be able to finance it. And so I think it's over to Ken to give his update on how this might be achieved.
Yeah, sure. So I guess, with the myth, is it better to buy more property than to renovate? One thing that I probably wanted to highlight here is that purchasing a property and renovating could mean that you're looking at different loan structures and different loan products. So the first thing there is that to fund a renovation, you could either get a cash out, so just basically increase your loan amount and use that money to do your renovations. The other one could be like a construction loan, or it could be a line of credit. A line of credit basically is like a credit card secured against your house, meaning,
That sounds good.
Yeah, it literally is, an amount that they've given you access to could be 50,000, 100,000. And when you draw on that money, or when you withdraw, take funds out of that loan, you start to pay interest on the amount that you've taken out. So that's usually a more expensive product compared to the other two. But in terms of deciding which option to go to or which product to use, it'll come down to the lender and your financial position as well. But the lender is also going to be a critical factor here, because some lenders will require you to will be okay with a cash out scenario. So you're just saying, hey, I want 30,000 or X amount of dollars to do my renovations, cosmetic renovations, and they're okay with that. They usually have a threshold in terms of how much they would deem it okay as a cash out. Other times that you'll need to provide supporting documentation as well in terms of invoices and things like that, the cost to complete the renovation. But if it's more than that, it may skew towards a construction loan where the lender will assess, will need to know exactly what the contract is for the renovation, the jobs, the quotes, how much is expected to cost, and then they'll release the funds to kind of have that construction or to feed funds for that renovation. So it really does depend on the lender and whether it's deemed as a cosmetic renovation, like, hey, I just want to update my kitchen or living room or a couple of rooms, things like that, put some new code internally and externally, or whether it's deemed structural. That's going to depend on the lender as well.
But people, at the moment, we've still got the opportunity for people to sign up to Home Builder.
Yep.
So I've heard some of the knockdown rebuild suppliers are advertising the fact that you can get that grant even if you do a knockdown rebuild. So if someone has been thinking about renovating their home and they're on, a block that meets the requirements, they might be able to knock down and rebuild a duplex. So, I know that there's sort of a few things that you'd need to work out, but that home builder grant, that's 25,000. So it's nothing to be sneezed at.
Yeah, I think, so adding on to that, I guess it does add another dimension to the project. I guess with the renovation, you're making decisions, it's internal, there's no real council involvement in terms of approving like the steps to develop.
Complying,
But to talk about the home builder, 25,000 is the grant. And one of the key criteria is you need to have commence the contract from the contract date, the construction, and you must sign the contract between the 4th of June 2022, the 31st to the end of the year, 31st of December 2020. But there is also other. Yep.
What was that?
Sign a contract on New Year's Eve.
Well,
and
they
just
might.
a minute before midnight.
I know the
in.
HIA is campaigning to adjust the date on that, because it was a very short timeline, and with the virus crisis extended. Yeah. But anyway, sorry, Ken, keep going.
So there's logistics in there, and I guess that's risk as well. Yeah, because you could have the planning process could take longer than 3 months, as well as approval process. So the other eligibility criteria to highlight would be if you're building a new home, the property doesn't exist a property value does not exceed 750,000. And on top of that, for a substantial renovation of an existing property, the renovation contract needs to be between 150,000 and 750,000. And the existing value of the house and land can't exceed 1.5 mil. There's also income criteria restrictions, or criteria to meet. So if you're an individual, you can't be earning more than 150,000 per annum. And if you're a couple, that figure goes up to 200,000. So there are,
I think they're reasonable criteria.
to jump through. Just adds a little bit more things to consider, I guess. But if it makes sense, you'd be eligible for the 25,000, and you can renovate and get equity out of the property, or increase the equity in your circumstance. So it is possible, but just how it's structured in terms of getting the money would depend on your circumstance, what you're trying to do, and also the lender that we end up researching and finding. So that's all from me, I guess, in terms of securing the funds for the renovation side of things.
So
John,
what's your view, John? Yeah.
What's your take, John?
Yeah, well, the good news on the rental front is that this strategy works. It works on the rental front, and over the years, I've got hundreds of examples of renovations, but I'm going to show you one recent one. Now, Real Property Manager has extended its offering because I thought about this long and hard. As a property manager, we're already doing property maintenance, and we've already got the crew to do it. And in markets like this, how do you create that manufactured equity everyone talks about? Well, one of the best strategies is to update and upgrade your rental property to push the returns further. So given that this strategy works and has been trialed and tested, we're now extending the service to a rental renovation. Now, rental renovation is different to an owner-occupier renovation, and how we handle it and what sort of money we put into it to get the best return. Because the key is not to overcapitalize in the rental properties. So let's have a look at an example. Deborah, if I may share the screen now.
Oh, is it not letting me do that? Oh,
No.
There you go.
I'm being blocked.
Try now.
Okay, so here's
Oh, pretty.
okay, so here's the classic inner west. This is Rozelle in Sydney. Classic workers cottage in Rozelle. That this particular client that I work with has owned that property for a long time, well over 20 years. She's been fortunate in the sense that she had a tenant in there for a very long time. The one tenant, well over a decade tenancy, without needing to spend much until the tenant gave notice and needed to vacate. So that triggered some questions around, well, what do we do? What do we do here? It's in much need of work. The rents she kept pretty low given the pre-existing condition for many years, and of course, CPI and the costs keep rising every year. It got to the point where financially this property wasn't performing at its best. So we looked at it and we did a feasibility of what it could look like with a minimum outlay on basically a cosmetic renovation, not structural, to avoid any council intervention, any DA and costs involved in DA, and of course the huge time delays that can occur if you go down the path of lodging anything with any particular council on the DA front. So we decided to do a rental reno. And let's have a look at just a couple of pics really here of what it looked like before the reno.
Oh, wow. Wait a minute, is that a before?
That's the before.
Yep.
Okay, so kitchen was already kind of 15, 20 years old. Paintwork was, around that time frame as well. We decided right there's the living room with a fireplace, and you can see it's got this kind of breakfast bar thing in the way that was traditionally there. We decided to do away with all that.
Wow, that's nice.
And turn into what looks like this. So there's that breakfast bar thing gone. Yep. And we moved the plumbing across to the other side. Yeah. So the plumbing was here. Moved it across. Got rid of a laundry that was right here, like a little closet laundry, and put it out here somewhere.
So you would have had to redo the flooring?
So we didn't have to redo the flooring except for polishing it and resurfacing it.
Looks a lot brighter compared to the previous.
So we've brightened the whole place up. We got rid of the yellows and the blue pascals and did the classic antique white USA. That's the classic rental white. Put new lighting in and really brightened up place with new appliances. Got a dishwasher in that it didn't previously have.
All right. Yeah, I can see the
Okay,
dishwasher.
so repainted the whole place and turned the decking area outdoors, which was pre-existing. Did a bit of landscaping outside and turned it into something that looks like
Lovely.
this.
Wow, nice.
Great.
Okay, the bathroom was in good condition. Everything else was fine. The wiring was fine. So really, it was kind of very, very cosmetic paint, polishing the floors throughout. And the major one was the kitchen and a bit of the outdoor decking, resurfaced the decking, painted the house on the outside and inside, put some new blinds in, put some new light fittings in. And we got it in on a budget of about $40,000.
Wow, and duration?
Okay, that was turned around in a pretty tough time, but the workers worked away over Christmas to get the project done in 4.5 weeks. That took 4.5 weeks because they planned it out nice and early in October. Right, so the timing and planning is crucial. They planned it out in about October and got the materials and everything pre-ordered before the factory shut down. Got all the materials delivered and basically started the strip out of the kitchen nice and early, materials ready to go, white goods already got delivered.
That's amazing.
And basically got everything done and back on the market in the middle of January.
And what would have been the rental differential?
Okay, so the magic with this, the result was terrific. So previously the property was renting in the unrenovated state for $620 per week. Now this is a 2-bedroom, 1 bathroom, internal laundry, and no off-street parking.
Yeah, that's still pretty good.
Okay, so $620 a week. That was an income of $32,000 per annum, and the property got re-rented for $795 per week.
Wow.
$795 per week. This was about a year ago, Deborah. This was pre-COVID, when the market was buoyant. Houses in that particular area are very sought after, especially with families.
Yeah.
And of course, they're not building these cottages like they are building apartments. So the houses are the scarce product in that particular marketplace in Rozelle. And $795 lease was signed for 12 months. That's a $41,000 income now, gross income. So that's a differential of about $9,000 per annum. In rents with, I did the calculations, that's a 28% return on the investment.
And the valuation, which, you know, is a moot point at the moment because they're, it's a moot point because they're going to retain it, but still you can imagine it would have done a lot for the equity side. Absolutely,
yeah. So on the equity side, it got immediately revalued at $150,000 uplift immediately that year.
Yeah.
So that's that's a fantastic result. 28% return on the investment of $40,000, and of course the equity uplift to enable to for the owner to do whatever she wants to with that equity, to reinvest or go out and buy another property. But just purely on the investment that she's held, she's done very, very well. And that renovation will be paid off in 3-4 years. Plus, she's got the depreciation as well. So she's just depreciating the renovation for the capital works.
Yeah.
So there's the other magic key with renovations. You've got the depreciation. And we did a report, and now she's got that tax benefit.
Yeah, that's so good. So I understand you do these quite frequently for your clients, John?
I'm really encouraging this at the moment while the market is laying low and rents generally have softened. I'm really encouraging property owners to go out and do this sort of thing as an easy way to uplift their cash flow, uplift their equity, and get their properties ready for when the time that we return to the more buoyant market. They're just going to get an even bigger uplift.
That's right. Yeah.
And the one thing I just want to say is that this strategy can work in different markets, but it works terrifically well in the markets like the market of Rozelle. It can have a really fast effect.
That's right.
Because of that supply-demand situation. So the market can do the heavy lifting for you, and just depends on the location and the type of property.
Yeah, and it really starts with a good feasibility, realistic calculations and estimates. And yeah, you need experience for that.
So
look, there's obviously a big push for renovations at the moment, and there's different marketing companies and different strategies going on with renos, and of course the popularity of the renovation shows on TV. You know, you get that bug, and all of a sudden you see all this success stories, and that's all you see, just the success stories, but you don't see the failures.
Yeah.
You know, nobody wants to talk about the failed renovations, and there are many of those, of course. And you really have to plan it out before you do this, and not kind of all of a sudden get the bug and go out and do it expecting just kind of this instant return. It's absolutely crucial that you've got the right type of property in the right location, and you don't overcapitalize, because renovations can be a very emotional thing. And
they're addictive.
They're addictive, and you can go on a crazy, shopping spree in Bunnings, and start buying upmarket fixtures and fittings and all sorts of things that absolutely make no difference whatsoever if it's not the right property in the right location, and the market won't support it.
Yeah.
So I've got a question for you, John, just in terms of logistics. So let's just say a landlord does have a property. In terms of choosing whether to renovate it or not, like, does it matter if there is a tenant in there or not, or is it ideal maybe to have it vacant to kind of complete the works? Like, how does that usually work in terms of?
Yeah, I've seen some landlords wanting to kind of have the cake and eat it too, and keep their tenants while they're renovating. I would never encourage that. I just wouldn't go down that path. There's a lot of risk there to do that. But I have seen some tenants agree to it, but then they've had to go and rent somewhere else for a short period of time. Okay. Which is fine, but they want you to pay the cost of that. They're not willing to pay double rent. Yep. So there's got to be a give and take, Ken, where they stop paying rent on your premises, move out, go somewhere else. But the expectation is always, well, if I'm going to be inconvenienced and I have to move, I want you to pay for that, pay for that cost. I don't normally encourage large-scale renovations to be done with tenants in them, or there's a contract in place. Rather do it when it's vacant. And secondly, keep the money in your pocket as long as you can until the time comes where the tenant does give notice and needs to move out, is going to vacate. Okay. So keep the money in your pocket. Only do the absolute necessary things to comply with, health and safety regulations, but don't go all out and do this kind of project while there's a tenant in there.
Okay. So it might be an opportunity for someone who's maybe not getting their property tenanted at the moment, or they may be struggling to kind of get it out on the market. So just do the capital work improvement and then set it up for.
Yeah, that's a good point, Ken. And there are properties that are starting to struggle in this market that are not up to standard, are not up to scratch. And they're the ones that are going to fall on the bottom of the list when tenants are out looking, because what's happening at the moment is you've got the newer, shinier, renovated stuff falling in rental value and catching up basically almost on par with the old stock. Yeah. Right. The gap is closing. The gap is closing. And guess what? Those old renovated, unrenovated properties are just going to be left behind.
Yeah. And this works not only for houses, but for units as well.
Absolutely. Yeah. Yeah. So the rough kind of budget on a classic 2-bedroom, 2-bathroom apartment could be around about the $20,000, $25,000 mark. But when you get into the houses, budget for around about the 40 to 50 mark, providing you don't have, major damp and waterproofing problems, because that can have a cost blowout, issues with rising damp and things like that in terrace houses. So providing the bare bones are structurally okay, you don't have major issues, with the foundations and damp in particular, and you're just going all out, in and out with a cosmetic reno, you'll be budgeting for around about the 40 to 50 mark.
And in relation to this service, John, is this corralled mainly to a particular area of Australia, or can you do it?
Well, my particular business concentrates on the in the west market. That's there's a lot of
inner west
old
of
unrented
Sydney
properties. My particular one. That doesn't mean you can't go out and engage others who are servicing the outer areas and suburbs, but this particular business is concentrating on the inner west and inner city markets.
Inner west of Sydney.
Inner west of Sydney.
Yeah. Yeah. Okay. All righty.
Yeah, we're not national. We're local.
Yeah.
At this stage.
But watch this space. Maybe expanding.
Yeah. So we've already completed about 4 or 5 projects successfully, and those properties got back on the market and rented pretty quickly. And without a doubt, the facelift of those properties helped achieve the result. I guess the first thing the investor hesitates is that cash outlay, Ken. So it's either they're sitting on the cash,
Yep.
and it's just sitting in the bank account, 0.01% return, and they're not willing to, risk the money on the stock market, or they're not making a move into another property.
Yep.
The best return I have seen is in renovations. So it's either they have the cash to do it, or how can they get the cash to do it?
Yeah, that makes sense. I mean, just to add on to that, I guess borrowing capacities with interest rates, decreasing. Although with that said, borrowing capacities may have seen an increase. Although the recent HEM, household expenditure measure benchmark numbers have come out, and I think there's been a few lenders who have reduced. It's had a negative impact on borrowing capacity. So people have seen a reduction. One of my clients had to reduce the amount that they could borrow. But yeah, I mean, if they're sitting on the funds and they've got the capacity to service the additional increase, yeah, that definitely.
Yeah, I mean, if they want the best return on their money right now without high risk, and they've got their property there to do it with, I can't see a better strategy right now than to
There
do
isn't.
this. Yeah, this is when you can get 25 to 28% return on your money in 4 to 5 weeks' time. That's a fantastic result.
Yeah, and that's setting aside the equity side of it.
Yeah.
Okay, alrighty. Well, thanks very much for that, John. And I guess it's time for us to wrap up. So thanks very much for watching. You can reach any of us at our own company websites. So John at realpropertymanager.com.au, Ken at avvora.com.au, or me at propertyfrontline.com.au. And if you have questions, you can go to our Facebook page, Property Mythbusters, ask us some questions or list some myths that you would like us to address. Okay, so bye for now.
Thanks for joining us.